All attendees are in listen-only mode.
Good evening, everyone, and welcome to the February edition of Digging into the BI. This is where members from the Maryland chapter and the DC chapter get together and look at the latest issue of Better Investing magazine. Tonight, we're going to be looking at RTX, it used to be Raytheon, Toromont, Kraft-Heinz, and Amazon. And so we're glad that you're here. And let's go over to the next slide. And Cheryl, why don't you take it over? If you're talking, we can't hear you, Cheryl. Are you there? I can't hear you. Am I the only one that can't hear her?
I can't hear her either.
I can't hear her.
Her microphone's on. Well, Cheryl, we can't hear you. If you can just move the mouse, I'll continue to talk. So let's go to the next slide and let's go to disclaimer. As you can tell, folks, we've had a little bit of trouble getting things going tonight. This is what happens when you have volunteers doing it.
Disclaimer slides up.
Oh, I'm not seeing it. Go ahead and take it over, Lee.
Well, this slide just presents the disclaimers to let you know that we're volunteers and that anything that we present tonight is for educational purposes only. And presenters are not encouraging or promoting the use of the website's products or services. And we encourage you to do your own research before acting on any of the information that's provided here tonight. Next slide. You want to pick it up, Kevin?
I can't see. I still have the old one. I must have some buffering problems, so take over.
Okay, as you'll see, folks, that we are an investment educational organization. We're focused on long-term fundamental investing, and we are all volunteers in the Mid-Atlantic region, the DC regional chapter, and the Maryland chapter. Next slide. This is the link to our YouTube. If you go up on that link, you'll find all our presentations from the past. If you haven't signed on to this link, we encourage you to do so. Each link is, and the webinar is organized by chapters. And currently, we're working on a goal of 150 subscribers. I'm not sure how many we have now. Next slide.
I can take over. I can now see things. So if you're having, so again, folks, sorry, we're having some technological problems here. So here's the thing to take a look at is this is where we list, if you have any trouble with troubleshooting, we obviously should be looking at this ourselves. But if you look at where that green line is, that will take you over to the handouts. And tonight you're going to be able to see the slide decks that we have tonight are all in one, all the presentations are in one document. And then we have 4 completed SSGs. So go ahead and make sure to do that. Let's go to our next slide. So why are we doing this? One more slide. There we go. Well, we're doing this because we like to be able to test our technological brilliance, and we're obviously failing today. But more importantly is that this is a way for people to be able to look at or get the best use out of their magazine. If you're new and you haven't done this before, we can show you some of the resources that are available regardless of where you are. And what we're going to do is we'll focus on this. Some of the stuff is for beginners, some of it for people a little bit more advanced. And we're going to basically sort of help people get through this, promote our model clubs, and also the Club Connect program that Cheryl will be talking about a little bit later. And also to be able connect with other people in the Mid-Atlantic. But if you're not in the Maryland, DC, or Virginia area, that's okay. You're welcome to be here. And if you're not even a member of Better Investing, you're welcome to show up. We're just trying to show you some of the resources you get as a member of Better Investing. Next slide, please. So in just over an hour, we're going to do 4 SSGs. We're going to look at the stock to study. Then we're going to look at the undervalued feature. And then we have 2 other stocks that come from wherever people have found it through the Better Investing resources. And so one we found through, it was found through a custom screen, and the other one was because they were a stock watcher for their company. But those are some of the other places that we can find these things. Let's go to our next slide. And so here's where we initially got everything. It's the news release. And again, this was done back in November. And you can see that they already have the stuff up for next month, where it's going to be Vertex Pharmaceuticals and Martin Marietta. Next slide. And don't forget to be able to take a look at some of the announcements that you can get from the local chapters. If you're in the DC regional chapter, you can use that. You'll get their news. If you're in the Maryland chapter there, if you're in someone else, we can do that as well. Let's go to our next slide. Okay, let's see. Oh, so this is again for members only. And this is where you get to see a weekly newsletter. It's a great place to be able to see all the things that are going on in the community as it is. And right now there's a couple different things that are kind of interesting. They have a stock screen for value. That's where that gold arrow is pointing to. And then we also have a learning center where I think it's kind of interesting. They're looking at how to use PERT to sort of upgrade your portfolio. I've always had to sometimes work a little bit harder on understanding all the things in PERT, and that's always a good refresher for me to take a look at. But there's a lot of good things that are in here. Make sure you sign up for it. If you do sign up for it and you don't get it, it usually comes down to the end of business on Thursday, is check your spam filter. Next slide, please. You can also connect with us on Facebook. There's both one for the DC chapter and also for the Maryland chapter. And we put up notices there. Again, you don't have to be a member of Better Investing, but you can do it. And let's give it over to Cheryl. Is your microphone working? And can you tell us what's going on with the DC chapter on page 12 or slide 12? Can anyone hear her? I can't.
No, and it's not even coming across as her mic is even picking up. Sorry, Cheryl.
All right, I'll take over from here. So this is the upcoming Maryland, this is the Money Matters Book Club. They're meeting on the 20th. It's the 3rd Tuesday of the month. And they're looking at talks at Google. You can sign up for the information on here. It's a great group of folks to be able to hang out with. I haven't looked at this this story that's going on here. This what Mikio Kaku. But anyway, looks pretty good. Next slide. Richard, take it away. Richard, you're muted. You have to unmute yourself.
Okay. Well, let's try this again. Hopefully everybody can hear me.
Yes.
Okay, great. I'm the president of the Montgomery County Model Investment Club, otherwise known as MCMC. We started back in 2017. We meet on the 3rd Wednesday of every month. From 7 to 9 p.m. Every month we have a new education topic. This month's will be the attributes of compounding. And we also have a stock to study, which will be Martin Marietta Materials. Next.
Cheryl, is your microphone working yet? If not, well, Cheryl's part of the Model Investment Club of Northern Virginia, also called McNova. They have 13 partners. They're meeting on the second Tuesday of the month, so that will mean next week, next Tuesday. And what they're doing is they have a beginning investment series that they're sort of doing as part of their education. And then their stock study will be Alliant Technology. And we jumped a couple slides up. Let's go back 2 slides, I think. 1 slide. Slide 15 is what we want to be at. And this is what we talked about before. Is there used to be a visit a club program. The new thing here is called Club Connect. It's a way to be able to, if you're looking for new partners for your club, if you're looking to join a club, it's a little bit more advanced than what we used to do with the visit a club program. There's a hyperlink over there on the left-hand side with the blue underline. In fact, anytime you see an underline on any of these stuff, if you have it in the PDF and you click on it and you're connected to the internet, you will go to that location. So here's where you can find the Club Connect, where that red circle is, and you can be able to fill out the information for your club, or if you're looking to join one. And you don't even have to be a member of BI. You can do it on a free 90-day membership and just sort of test out and see what's going on. Next slide. So this issue of Better Investing Magazine is a combination with January and February, so it came out about a month or so ago. But this stuff, this is a way, most of us tend to wait for the magazine to come in through the mail, but you can get it through the app over on the left-hand side, or if you go to the website, you can get it through the e-magazine. And they actually did some new interesting things with the e-magazine where you can do, it's much better searchable and a great way to be able to store and write your notes. So normally if you like to be able to highlight or mark your magazine, you can do that electronically as well. And both the app and the e-magazine can be used on a computer, laptop, tablet, smartphone, any other electronic device that connects to the internet. Next slide. And this is where you can find those magazines. The first thing is that if you see the green arrow over on the left-hand side, that's where the Better Investing Magazine for mobile devices is located. It's a different sign-in than what you have for your regular one. So you got to click on that and go through it. The other thing is that that red arrow over there, that takes you to additional documentation that shows up for either the stock to study or undervalued feature. So if you see in the magazine that they're talking about you, there's additional stuff at the website. This is where you find it. Next slide. And then here's the story that we're featuring this month. It's actually the cover story, the 60/40 portfolio. And I thought the lead on this was really quite interesting. It talks about you want to start a stirring debate among financial professionals and see if the 60/40 portfolio still works. And that's where you have 60% of your portfolio in stocks, 40% in bonds or income-based stuff. And that there's a big debate going on in the financial professionals. So it's a very interesting article. Go ahead and take a look at it. Next slide. And here are some of the things that are coming up in the next month or so. One is the one in the maroon or reddish box. That's from the South Florida chapter. They do a free series. One is going to be a week from today. They're doing a credit market series where they're showing you how to read the credit analysis reports. So you can be able to take a look at that. You can just sign up for it free, just like you do this one. And then also over in the green box in the lower right-hand side, that's the Northeast Ohio chapter. And Doug Gerlach is coming there to be able to do a series of information there. That one's going to cost $20. But again, you can do it online and be able to be part of it. And that's going to be next month on March 9th from 10 to 2, 10 to noon Eastern time. Next slide. So here are the two stocks we're going to look at in core. First will be Cheryl Patterson doing Raytheon or RTX. It's the stock to study. Then Toromont Industries, that's what Richard's going to show us, and he found it through his predefined screen. Let's go to the next one. And Cheryl, let's hopefully you got your microphone working.
Hey, Kevin, go ahead and put her last, unless her phone connect is working, but she was trying to get connected via phone. And we're going to the next thing, so I guess she's not connected yet. There we go. Richard, you're up.
Let me turn my mic on. Okay, so today I'll be presenting Toromont Industries Limited. It's listed on the New York Stock Exchange as ticker symbol TIH.TO. It's in the industrials distribution industry and the industrials sector. It's a medium-sized company, $4.2 billion in sales, as measured by Better Investing. Next slide. So why did I choose that stock? I tend to like, I found the stock on the predefined stock screen, roster of quality. I presented the value line ratings for financial strength, price stability, growth, persistence, and earnings predictability. You know, they are all excellent, as you can see. I found TIH by focusing on industrial stocks in that screen. And also, I like the fact that it had a simple, easy to understand business model. It has two segments, business segments. Equipment group that sells, rents, and it services industrial machinery, primarily sold by Caterpillar. SIMCO group, we'll talk a little bit more about that, designs, engineers, fabricates, and installs recreational refrigeration systems and industrial refrigeration systems. Next slide. Okay, go the hard way. Toromont was created in 1961 by investors from Toronto and Montreal. It does have 55 years of continuous dividends and 38 of continuous upward dividend growth. It's one of the largest Caterpillar dealerships in Eastern Canada, as well as the Northeastern US. I don't think we can do the hot link, so we'll just move on. The equipment group is comprised of 5 subsidiaries, each with a special focus. We'll talk about those in a minute. And also SIMCO is the second group. Next slide. This one. No, back up one, I'm sorry. Gotcha. So Toromont Cat is one of the world's largest Caterpillar dealers. They supply a full range of heavy equipment. Toronto supplies and operates high-efficiency power plants for hospitals, district energy systems, and landfills. Battlefield Cat Rentals is a single source provider of rental equipment, construction supplies, tools, and training. SciTech specializes in site positioning and asset management. In other words, they operate and sell the GPS and surveying equipment. Job Site specializes in tool crib rental equipment, and SIMCO, as I mentioned, does refrigeration systems. Next slide. The financial summary for the third quarter of 2023, we can see that bookings are slightly down from about 11%, from 1.3 billion to 1.2, which is about 1 billion US, which is still a excellent business backlog. Revenues have increased 8% from year to date, and up sales, and that was last quarter, I'm sorry. And year to date, they're up 13.7%. Earnings for the last quarter were up 20%, and year to date for earnings are 28.9%. So it had an excellent third quarter. Next slide. What I hope to do here was to understand a little bit more about the mining construction across Canada, to see how it was distributed and how robust it was. So I found this map, which indicates two companies, Toromont and Finning. We'll talk a little bit more about Finning. That's their major competitor to Toromont. So Finning occupies the third west, the west side of Canada, if you will, the 1/3 on the west, and Toromont basically has the 2/3 on the east end. I found that the top 4 provinces in Canada, Quebec for mining, Quebec and Ontario, followed by British Columbia and Saskatchewan, which means that TIH Toromont has a bigger share of the mining than Finning. I also found 51% of Finning revenues came from Canada, or about $3.5 billion US, while Toromont's sales are about $4 billion. So actually, even though you'll see Finning is about twice the size in sales as Toromont, it is actually, as far as Canada is concerned, they're smaller. Also, the largest construction area in Canada is located in the Greater Toronto area. So they have a larger presence there. Next slide. Next slide. So let's talk about the peers in a little bit more detail. There are several smaller and non-public companies that I looked at and had to remove. And I tried to focus on similar industries. Next slide. Stay there. Go back one, I'm sorry. So Finning International is their largest competitor. It's just, the upper left-hand corner, you can see a snapshot of the front side of the SSG. They have relatively flat sales. They have a pretty big dropout in pre-tax profit in sales back in 2015. And as you can see, the value line ratings are much lower than Toromont. Finning sells internationally in Canada, South America, and in the UK and Ireland. So they're well diversified. Next slide, please. Another competitor is Blue Lynx Holdings. Blue Lynx is a wholesale distributor of residential and commercial building products, engineered lumber, millwork, industrial production. The front side of their SSG is pretty rough. The sales tend to trend upward, but the pre-tax profit and earnings are highly erratic and show deep negative earnings. So value line ratings are extremely poor, as you can imagine. Next slide. The last one in the peer group is RB Global. It's the world's largest auction company for industrial equipment. They sell over $6 billion in sales, so they're quite large. Value lines rating is better than the other two, but still significantly poorer than Toromont. The front side of the SSG shows a steadily increasing in sales, but a much more erratic pre-tax profit and earnings per share. In 2023, you could see a serious deterioration in earnings per share and pre-tax profit. Next slide, please.
5 minutes, Richard, 5 minutes.
Okay. So on a sales basis, I compared the 4 companies. You can see the black line is Toromont, which has about 13.2% growth over the last 10 years. The only company that's a little bit better than that is RB Global, but they have a highly inconsistent growth. So I would not rate them high, but the takeaway from this is historic sales of 13.2% are pretty good. Next slide. From an historical EPS standpoint, Toromont is 14% compared to the average of 20%. but that's distorted because there are some large negative historical earnings per share growth rates, as you can see circled. So that tends to distort the averages. And for Finning, I actually showed it. If you deleted the 2015 number, it's 18.6%. So it's tough to compare the earnings per share, but you can see that the upward slope on Toromont. Next slide, please. Pre-tax profit on sales, again, Toromont led the way with 11.4% compared to the other companies, but it has a nice smooth upward growth. Next slide, please. Return on equity, you can see a nice growth across the years on Toromont. There was negative growth in a couple of companies in 2018, which is tending to distort the peer group averages. Next slide. Debt to capital, easily the Toromont is generally lower than the other companies as far as return debt to capital, which is a good thing in this case. Next slide, please. So looking at the SSG, only a few things to point out on the front side. Relatively up, straight, and parallel. It is near the 52-week high. Dividend growth, I included here, is light green, is consistently upward. Sales last quarter a year ago was up 3%, and earnings per share a year ago was up 18.1%. Morningstar ACE analysis, ACE 2-year growth estimate is 5.7% for sales. Next slide, please. Fundamental for management. Generally, the company is doing quite well. As I mentioned earlier, their 2022 pre-tax profit on sales was 14% compared to the 5-year average of 11. Return on equity is 20% compared to the 5-year average of 18. And debt to capital is relatively flat and trending downward. Next slide, please. So I looked at the sales figures, as many as I could come up with, and the data was relatively scarce. The best source of data I had was Value Line, which I'm showing here. They had a compound annual growth in the annual sales of 7.5%. So I went with that, but they also indicated a relatively flat 2024. So I decided to make that 3.2%. Yahoo has 2024% at 2024 at 3%, and the Morningstar ACE numbers I mentioned. So the average of that information is 7.4%. Historically, they've been doing 13.4. Member sentiment had only 10 studies, so the data is not high quality. So my judgment was to go ahead and use the sales growth estimate by Value Line at 7.5%. Next slide, please.
Richard, sorry, you've got 1 minute left.
Okay, I may tend to run a minute over. The earnings growth rate was the same issue, limited sources. The average was 10%, but with 2020 hindsight, I felt that number turned out to be too high with any reasonable high PE we'll see. Preferred procedure had 7.6%, so I decided to go ahead with that. 7.6% is the best estimate. I used Value Line numbers to come up with the preferred procedure. Next slide. So the judgments were 7.5% for sales growth and 7.6% for earnings growth. Next slide. I debated the high PE quite a bit. I tried to keep the high price within reason of the high upper price limit for Value Line, which is showing a projection of $160. And as you can see, the 5-year average, the 5-year average high PE was 25. Value line projected average PE of 19. I chose a judgment of a high PE of 21, which gave me about a $195 high price. Next slide. Low PE was also challenging. The 5-year average high low PE was 21. 5-year average low PE was 17. I decided to go with low PE of 15 based on the current low price divided by trailing 12 months. And that seemed to work out pretty well. Next slide. So from evaluating the risk and reward, the upside downside ratio turned out to be 4.3 to 1 with a total return of 69.5, which was a little low, but for a medium-sized company, it's still reasonable. A 15% return and a 3 to 1 upside downside ratio would require a price of about 115. It's currently about $118 a share. And to conclusion was, Toromont is a high quality company as backed by key management performance measures and 34 years of consecutive dividend growth. It's an exclusive Caterpillar dealer for a contiguous geographical area in Eastern and Mid-Canada. Revenues are well diversified across product support, sales, rentals, and refrigeration equipment. As I said, the upside downside ratio is 4.3 to 1 with a total return of 12.7 using what I consider a conservative valuation. Toromont is a candidate to buy or for your watch list if you're waiting for a lower price, but do your own research. Thank you.
Thank you, Richard. Appreciate it. Let's go.
Can you hear me, Kevin?
Yes, we can.
All right.
You want to go back to yours?
Please. What slide number?
Try 21. If you just hit 2-1 on your screen and then hit the enter, you'll go back to that page.
There we go. All right. Hi.
Take it away. You sound faint.
Excuse me?
You sound faint.
Get closer to my
There. Now that's great. That's great.
Okay. I'm going to present Raytheon tonight, RTX on the New York Stock Exchange, and it's February's undervalued stock. So here are 2 articles for the undervalued stock to study. RTX is talking about the Russian aggression, leading European nations to bolster their defenses. Raytheon, starting in 2020, took on some acquisitions. One of them was Pratt & Whitney. They had a rare condition in their powder metal driving accelerated engine, and they had to have removals and inspections. Now, according to Value Line, the majority of the replacements on the engines were in the end of 2023 and the beginning of 2024. So they're beginning to be behind them. And here's the 2023 highlights. Adjusted sales of $74.3 billion. Adjusted earnings of $5.06. Free cash flow of $5.5 billion. And company backlog of $196 billion. Here is the fourth quarter of last year. They had a 10% organic growth. They were up 2% in the adjusted earnings per share and an increase of $4.7 billion in the cash flow. One of those segments that they acquired in 2020 was Collins Aerospace segment. They had organic sales up 12% in that last quarter, and adjusted sales of also 12%, with operating profit up 22%. Here you're seeing the release of ARCUS, a new image generator that is going to give superior simulations of real-world conditions. The second acquisition was Pratt & Whitney. Their organic sales are up 14% and profit up 26%. And here you're seeing the Pratt & Whitney Canada, they did their engines. And the original Raytheon segment, their organic sales are up 4%, reduced by the organic powder that we talked about previously. And they've got one of the largest orders of the GEM-T interceptors, which is going to go out to support European nations. Here's their estimated outlook for 2024. Sales up 7 to 8%. Adjusted earnings per share between $5.25 and $5.40, and the free cash flow around $5.7 billion. Again, we're looking at the different segments here of Raytheon. 2023 commercial growth is 20% for their OE, 23% for commercial aftermarket growth. Talking about that same backlog that I said a minute ago, and the backlog growth is going to give them year over year another 12%. Now, looking at the different tiers of Raytheon, Raytheon is still doing well in the recent quarters. They're ahead of the other competitors of Honeywell, General Electric, and Boeing. The earnings per share, they are ahead of that industry average. There's a huge amount, and that's because they had all those negatives from 2014 to 2018. And again, in the recent quarter, Raytheon is on top with 9.4%. Looking at management, you have the recent quarters again, 35%, which is well above Honeywell, which is the only other positive change in the grouping. Core SST sales forecast, I'm using 10%, and that is going to give a 5-year projected sales of $110.996 million. The earnings per share forecast, I use 12.2%. That is going to result in a 5-year projected earnings per share of 3.97. And Value Line is showing the projections for 2026 to 28 as being somewhere between 19 and 24% annual total return. If you look at the PE ratio up on top, it was 15.3% compared to the average annual PE ratio of 18%. And you can see the Value Line, the price is well below. The forecasted high price, I used 38.3% for the high PE forecast, and that gave me a high stock price forecast of $151.09. For the forecasted low price, I used average low PE forecast of 21.3, which gave me a low stock price forecast of 175.7. And I went down to a low stock price of 202. Here you can see that the upside downside ratio is 2.4 to 1, which is a little bit into the hold area. Here's some news that you can use if you want to look further into the products and the news on Raytheon. You can click on the hyperlink here. In conclusion, Raytheon is a large-sized company. They've had past setbacks with their engine defect, which is their future historical, commercial aerospace and defense. They're overvalued, trading above their 5-year average PE, and it's a buy up to $82 for a 3-to-1 upside downside and a 15% return. And I believe it would be a worthy candidate for a watch list.
Thank you very much, Cheryl. I'm glad we're able to get your connected again. Okay, let's go to slide 67. Okay, so now we're going to look at two stocks using SSG Plus. The first one's going to be Kraft-Heinz. That's the undervalued feature for this month. And then we'll follow up with Amazon. And this is Robert has done it because he's the stock watcher. So let's give it over to Lee Outlaw and tell us all about Kraft-Heinz. Take it away, Lee.
Good evening. I'm Lee Outlaw, volunteer director for the DC Regional Chapter, and I'm going to present Kraft-Heinz, which is on the New York Stock Exchange. And as Kevin said, it's the undervalued stock for the month of February. It was also top 150 stock last April. The BI Editorial Advisory and Securities Review Committee selected Kraft-Heinz because the stock's valuation may represent an investment opportunity. The undervalued company goal aims to increase total return 20% within the next 18 to 24 months. Next slide, please. So this is the article in February's BI magazine. The article provides a good synopsis of Kraft-Heinz history, the challenges it's faced in recent years, and the action it's taken and is taking to short the company's competitive position. I'll highlight a few items as they provide good context for much of what follows. High inflation rates in recent quarters have pressured food budgets. Many consumers cope by trading down to cheaper private labels, which represents a major challenge for processed food giants such as Kraft-Heinz. The review committee expressed optimism that the right management moves, and with the right management moves, Kraft-Heinz can hold its own or perhaps regain lost ground. Over the 4 years to 2024, the company aimed to increase marketing expenditures by up to 30%. Management has also been conducting a 5-year, $500 million a year cost-cutting program. As this is occurring against the backdrop of a change in the guard, Kraft-Heinz replaced its CEO on the 1st of this year. Analysts anticipate the new CEO will continue implementing the competitive counter moves set up by his predecessors over the past 5 years, who has been moved on to serve as non-executive chairman to ensure continuity. Not mentioned in the article is that the departing CEO came on board in June of 2019 following an SEC investigation of the company's procurement and accounting, which has since been put to rest. Kraft-Heinz periodically complements its organic growth with acquisitions of relatively high margin businesses, and recent emphasis has been on international front, particularly emerging markets. In contrast, Kraft-Heinz has diverted a few lower margin divisions. Next slide, please. So Kraft-Heinz is headquartered in Pittsburgh. It's in the packaged food business. It's a large company in terms of sales. Kraft merged with Heinz in 2015, but the history of the company begins in 1869 when Henry Heinz founded Heinz in Sharpsburg, PA, near Pittsburgh. Kraft began its journey in 1903 when James Kraft began selling wholesale cheese in Chicago. Pictured are many of Kraft-Heinz company namesake brands. About 70% of Kraft-Heinz sales are in North America, but the company is aggressively seeking to expand its global reach. Next slide. So I'll highlight a few slides addressing Kraft-Heinz third quarter results. Kraft-Heinz fiscal year corresponds with the calendar year. They will report their FY23 results on the 14th of February. For the third quarter, year-over-year top line net sales increased 1.7%. Per the new president, unlocking efficiencies across the value chain and improved pricing to inflation led to constant currency adjusted EBITDA and adjusted EPS growing at a much faster pace, 12.9% and 14.4% respectively. The 14.4 EPS increase was Kraft-Heinz fourth consecutive quarter of positive year-over-year bottom line comparisons. Next slide. So on this slide shows the increasing investments Kraft-Heinz is making in SG&A and CapEx to drive organic growth. Next slide. For the third quarter, Kraft-Heinz experienced very positive year-over-year growth across the three pillars shown that drive their growth engines: food service, emerging markets, and U.S. retail platforms. Next slide. Year-over-year results on this slide reflect Kraft-Heinz significant investments in marketing, R&D, and technology. You can see the positive percentages compared to third quarter 2022. Next slide. So for third quarter results, Kraft-Heinz demonstrated encouraging movement in all three of these balance sheet metrics. And in the case of net leverage, lower is better. Next slide. Their fiscal year outlook based on third quarter results. Kraft-Heinz has made revisions to their year-end outlook. They narrowed their long-term algorithm growth to the lower end of the 4 to 6% range. They raised their constant current adjusted EBITDA guidance to 5.7% growth. That excludes the impact of the 23rd week of 2022. And they also raised their adjusted earnings per share range to 2.91 from 2.91 and to 2.99 from the previous range of 2.83 to 2.91. Next slide. So quickly, what does CFR say about Heinz? They've given it a buy range with a target price of 40, which is 14.5% of the price at the time of selection by the Editorial Advisory and Securities Review Committee. CFR considered the 20% year-to-date decline at the time. That was a factor in their recent upgrade from hold to buy. But they did note that Kraft-Heinz has taken the right steps to transform its business and set itself up for stronger growth, as evidenced by major reorganizational shift, large portfolio divestitures and target investments in emerging markets and high growth channel categories, i.e. food service. Also, their debt is reaching more manageable levels. Next slide. Okay, so this is Morningstar's take on the bulls and bears. I'll just focus on the bear column. Inflation, supply chain disruptions, and decisions Kraft-Heinz makes concerning its debt load could impact its performance going forward, and I assume that's adversely impact. Next slide. So here's a value line report analysis. They noted the increased progress that Kraft-Heinz has made in the third quarter. They assess their outlook for the full year as favorable, and they say the shares remain an attractive long-term holding. They project sales of 1.5 and earnings of 5% for the 3 to 5 year range. And I tend to give more weight to the end state. That's what I call the figures on the right column, projected sales of per share of 23.6, sales of in millions of 2,900, and also their allocated dividends to net profits or their payout ratio of 49%. Next slide. So
About 4
here's
minutes, please. 4 minutes.
Sure. So here's an array of growth projections. Here again, I favor the EPS estimates, and the sales estimates are in straight numbers highlighted. And I use these to derive the sales growth and earnings per share projections for the FSG. Next slide. So here's the analysis of growth and quality. Can you reduce that a little bit? Maybe it's just my computer here. Let's see. Okay, that's helping me out. Okay, so EPS, if you look at the graphics, you see EPS took a hit in 2015 due to the Kraft-Heinz merger. I think the drop in ETS and pre-tax profit in 2018 was likely to fourth quarter profit contraction in the aforementioned SEC investigation. They also reduced their quarterly dividend. Hang on here. Plug in my battery. Okay, so I used, based on the information on the preceding slide, 1.9 forecast for sales growth derived from the projected sales, and I got 8.4 for historical EPA derived from the projected earnings per share. Looking at evaluate management, the trends seem to be positively. Next slide.
2 minutes, Lee. 2 minutes.
Okay, I'm going to run a little longer. So here are the KHC comparisons. I'll note that all of these companies, Campbell's, General Mills, Kellogg, or what used to be Kellogg, are considered a discount to fair value. Kraft and Campbell's a discount the most. One thing I'll note here is that Kraft is the only one that doesn't have an economic moat. Morningstar mentioned a couple things that the reason why they didn't give it to them. Returns on investable capital, including goodwill, have language. They don't believe Kraft's intangible assets or scale warrant an economic moat. And they don't believe that Kraft-Heinz enjoys pricing power. Some of its categories have become commodified. Next slide. Looking at peer comparisons, KHC's average sales growth exceeds its peers and tops industry and peer averages. Next slide. For historical earnings, their growth lags General Mills, but it's fairly in line with the other peers and industry averages. Quarterly data, I note, is different from that of its peers, not measuring the same period of time. And also state that the quarterly data here shown differs from what Kraft-Heinz and Value Line reported. Next slide. The peer management comparisons, KHC lags all peers and industrial and peer group averages for both pre-tax profits and profits on sales and return on equity. However, it's performing the best in percent debt to capital metrics. So next slide, looking at their price earnings history. In my view, their 5-year average high PE shown is not representative of the current situation. I took a conservative approach and chose a high PE of 20. Value Line gave an average PE of 16. So I thought that my high would be reasonable. I also used their payout of 49, which is well below what you see on the slide here for percent payout. Next slide. Okay, so you see the high PE of 42 gives a projected high price of 72.5. For forecasted low price, I use the recent 42-week low price, which look at 3, puts KHC in a buy zone with a upside down ratio of 5.4 to 1. Next slide. So this produces a high PE compounded return of 16.7. Compound annual forecast for average PE is 12.7. And per the zoning on the right, KHC is a buy up to 41.10. And it closed today at 37.22, which is only a penny more than the closing price I used when I did the SSG about 10 days ago. Next slide. I just put this slide on to show that if KHC recovers its price at the start of 2023, it will meet the undervalued feature goal of 20%. And in conclusion, next slide. I have KHC as a large size mature growth stock based on its positively trending management indicators. So I say it's a well-managed company. Current PE indicates it's undervalued as it's traded well below its 5-year average PE. Its current buy up to 41.10. Upside down ratio, 15% total return, and it's a worthy candidate to add to the watch list. You might want to check their fourth end of year report in a couple of weeks. And that concludes my portion.
Thank you very much, Lee. Appreciate it. And now we come to our fourth and final presentation, and that will be Amazon. Let me make sure we're seeing it. There we are. So we now have our 30th new presenter. Robert Greenstein's going to be able to tell us all about Amazon, and he's a stock watcher in his club for it. So go ahead, Robert. Welcome to Digging into BI.
Thank you for the invitation. The next slide, please, is a delivery screen on my computer. I use Amazon a lot for so I can get deliveries to where I live. So this was I'm sure everybody has seen this. Next slide, please. So what about Amazon? Let me back up. I'm the stock watcher in my club. I took it over I was asked to take it over in November of 2023, and in doing so, I created a new SSG, and because I sensed that there's a dichotomy of opinion about Amazon, and it runs throughout this presentation. So fun facts, Amazon.com was the largest online retailer in the world in 2022, continues this position in 2023, $575 billion in net sales. It dominates the markets in online retail and cloud services. The breakdown by segment, they have a North America segment, 61% of the sales, international segment, 23% of the world, and Amazon Web Services, the cloud services, 16%. The web services are currently the primary income and profitability producer. Other numbers, they had 200 million Prime customers signed up worldwide at the end of 2021. I've been looking. I don't find it in the quarterly fourth quarter report that was issued on last Thursday. So I've asked the company to tell me how many Prime customers they have now and what does that equate to in the way of net sales. Breakdown by channels. Online stores, 43%, physical stores, think Whole Foods, 4% third-party sellers, 23% subscription services, 7% advertising services, 7%, Amazon Web Services, 16%. The point of showing this is that even if they have a lot more subscriptions, it only, whatever the increase is, it only acts on a smaller number of dollars, so it doesn't have that big of an impact. And they also are building capability in AI and embedding it in their product. Next slide, please. So I'm going to jump right to the SSG because that's what I was doing here was a new SSG. The 4 values we have to provide in the SSG tool, the sales growth, EPS growth, and high PE, low PE. I tend to use low price from price charts. But the sources, those are the 5 sources I used. Member sentiment and first cuts I use as validating information. Next slide, please. So for sales projections, I picked 11%. The range from before, the table before, was of 11 to 14%. I see a slowing down in the section 1 graphical presentation, and we'll see that in a later slide. The sales line is starting to flatten out, and I think that's important in trying to pick that's why I picked the low end of the range. And the year-over-year improvements in sales growth for 23 by quarter is in the same range. That small table at the bottom of the slide, 9 to 14%. Next slide, please. EPS. Now I went higher with EPS. The analysts projected growth between 16% and a high level of 80%. Don't know how you get that, but anyway, that was from the sources. Used a low level of 20% because it provided a projection out to $4.80 per share in 2028, near the value predicted by value line, which was $5 even. I actually constructed a line, grabbed the bar at the end and moved it to where I got a line that I liked, and I liked the result for sales and earnings, both lines, based upon value line projections. The graphical presentations are flatter and better looking to me. The next slide, please. Another view of earnings performance. Looking at the bar graphs, I always like bar graphs. I can understand them pretty quickly. The quarter one was a beat. That is a pleasant surprise. Quarter two, quarter three, and haven't seen this same graph yet for quarter four. What happened in 2022 was that they had to make, due to the, they had such a growth from COVID times, and then it slowed down afterward and required adjustment to the retail business. It contributed to negative earnings. So you'll see on the, I think the next slide. Yeah, let's go to the next slide. You can see the slowing down the level. My red lightning bolt is a red flag. I'm going to collate those toward the end and ask you as a potential, someone of interest, someone who wants to look at it, got to consider those red flags. There's the leveling off of the sales line, and then the dip in 2022 in profits and earnings, and now it's recovering, and that's good. And that says that management knows what they're doing. They can pull themselves back from the precipice there. Okay, next slide, please.
5 minutes, Robert. 5 minutes.
5 minutes. Thank you for telling me that. I'll speed it up. So pre-tax profit and debt levels on evaluate management, the 5-year average on pre-tax profits 5.1%, in 2022 is 1.3%. That's very low. That's not what I like to invest in. I like to be in something that's 20%. But this looks like a grocery store or a Costco. Also, the debt level is too high. I understand they need to carry debt, but I would rather see it lower. Next slide, please. PE, I struck a lot of those off because the 10-year table, I ended up using the 5-year average price earnings ratio for high PE of 67.3. Could use 83.3. I'm sorry, not quite ready yet. That's okay. We'll stay here. You can see the PE plot is steeply dropping even below the average, and that's a point of concern. Next slide, please. The relative values of the PE, projected PE greater than 100% indicate the PEs are out of balance, and the PEG ratio of 4.0 much higher than the desired range of 1.5 to 2.0. Also, liquidity ratios, current ratio, we will go into those definitions. Quick ratio are too low. Interest coverage is okay. Next slide, please. Next slide, please. We will Next slide, please. Thank you. So I ended up with an upside downside ratio. I used a forecasted low price of 81.70 based upon price charts and support levels. Upside downside ratio of 2.4 to 1, and the projected return, the par based upon average PE, is lower than we typically want to see. Next slide, please. All right, comparisons, competitors. I did find a couple of them, Alibaba and PDD Holdings, Pinduoduo, which is fairly new. At the request of another member, I put Walmart in there as somebody who is, you know, a retailer plus someone trying to get into the online part. But I didn't. You see, Amazon and Baba are parallel. Next slide, please. Thank you. So EPS, if you look at the green oval on the right in the table, the right column, Amazon's much higher because it was down, right? So that's why it's higher than Alibaba. Next slide, please. Pre-tax profit. Since I made an issue of that, there's again in that table, a right-hand column, 5.1% for Amazon, 5-year average, Alibaba 19.7. So somebody has been able to get a better number there. Next slide, please. So my observations, one of the issues within my club is that the SSG is a wonderful tool, but sometimes it's difficult to use. It's difficult in this case because of the high value that is high PE for Amazon and how fast growing it was and how high priced it was. Well, that's, yeah. So impacts of COVID and slowing economy required, and what they did was they went from a single distribution, fulfillment and distribution approach to 8 regional ones in the US. That's a big change. They had to spend a bunch of money to do that. So it's a high performing company doing a lot of things right, capable of significant future performance, not worthy of an, if you were considering on a core type holding where you would put more than equal share in your portfolio, I don't see it worthy of that. And I'm going to closely watch the EPS, the earnings reports for EPS matching, looking at the projections in the out years. One more slide, please. So risks, the red flags I identified. These are taken from Morningstar, but I think the most significant one is if they want to penetrate into internationally into third world regions such as India subcontinent or sub-Sahara Africa, might be harder because they're not going to have the logistics networks. I'll have to help build those up. Okay, next slide, please, and this will be the wrap up. Next slide, please. Yeah, that's it. Just a study. So it's mega sized, right? Very fast growth. It's well managed. They've been able to manage their way through their issues. It's high performing, doing a lot of things right. Future performance, I said 11% on sales. That's pretty good for something as huge as it is. It's in the whole range of my SSG with a buy starting down at 142.10. Currently, it's selling at 169. It's a worthy candidate to consider adding if you can justify the many flags that I see in the SSG and the audit findings table. Thank you.
Thank you very much, Rob. Appreciate it. There's also some additional information he has there that if you want to look at it,
Yeah.
and make sure to download
Yeah,
these slides.
those are other write-ups from other analysts, current write-ups.
Mhm.
Yeah.
Okay. So now we went through these, and we want to be able to ask all of our presenters to be able to sort of tell us where it sort of fits on this life cycle. And let's go to the next slide, and you'll be able to see what we're talking about. Regulars here will make sense of this. This graph over here, or this graphic, I should say, is something that's very common in the BI community. The digital handbook has it. It comes from T. Rowe Price, where he talks about there's a life cycle to a company. And so we're going to ask all of our presenters why they picked these locations. And we're going to start with you, Cheryl. And why did you pick that location for Raytheon RTX?
Raytheon has been around a long time. However, with the companies that they've added under their wing in 2020, they're still in mature growth, but they have not been counted out yet.
Okay. Thank you very much. Richard, you have Toromont at TIH.TO. Tell us why you picked that location for it.
Okay, well, it's a medium-sized company as measured by Better Investing in the $1 to $10 billion range. It's definitely not in the explosive growth arena, but I think it still has some growth moving forward, significant growth. So I kind of put it a little bit into the mature growth area.
Okay. Thank you very much. Lee, tell us why you picked that location for Kraft-Heinz.
Okay, so consider Kraft-Heinz a very mature company, mature growth. It's been around for both the Kraft and the Heinz have been around quite a while. And right now, their sales projections is in the low single digits. So I put it where you see it.
Very good. And last but certainly not least, Rob, tell us why you picked that location for Amazon.
Yes. Again, similar to RTX, I saw it. I put it in mature growth. I mean, it's still 11% growth for the next 5 years, but that's pretty good for a mega cap. But I think it's mature. I like where the curve kind of starting to lean over to going at a lower rate. So that's the reason why.
Okay, thank you very much. So let's go to our next slide. And I think, do we have any questions right now? Kent, do you see any questions in the question box? If not, Cheryl, go ahead and release a poll. Okay, here you are, folks. You can take a look at all the stocks. You heard us talk. Now you're a chance to be able to vote for which one you like the best. Doesn't cost anything. Let's see here. We got a pretty close race between a couple of them. We got just over 40% of you participating. Let's see if we can get up. Okay, well, now we're moving. We're up over 60. Can we get up into the 70s? Seem to be holding. Let's see if we can get one more vote. Got one more vote? Yeah, we did. Okay, go ahead and close it off, Cheryl. And let them see who our big winner is. There it is. Toromont was the one that people like the best. Very, very good. So we keep a tracking portfolio of this over on Manifest, and we'll talk about that in a little bit. Again, Kent, do we have any questions there? It's been pretty quiet the last couple months. You're muted, so if you're talking, we can't hear you. Okay, let's just keep going. And let's advance to our next slide. So if you need to be able to reach any of us, there's a picture of us from the Maryland and DC chapter at the last in-person BINC, which was in 2022 in Dallas. Come join us in Chicago in May of this year, 2024. But if you need to reach out to anyone from the Maryland chapter, there's their email. There's the one for the DC chapter. And if you have anything for this presentation, digging into the BI, there's a location for it as well. Let's go to our next slide. If you need to be on the list, again, I see a lot of regulars here, so you probably don't need to be on it, but you can share this. You do not have to be a member of the DC regional chapter, nor do you even have to be a member of BI to be able to sign up for this. We won't inundate you with a lot of emails. It's just generally telling you some of the educational events that we have. A lot of them are virtual like this, so you don't have to leave the comfort of your home, and you don't even have to be in DC, Virginia, or Maryland to be a part of it. So please sign up, share it with your club members, any other people that are interested in talking about investing. Next slide, please. Kent, do you want to give your usual spiel here?
Sure. You know, as you might have guessed by the seminar this evening, everybody here who does this is a volunteer, and we use this volunteering opportunities to learn new skills, particularly in our investing, but occasionally in presentations as well. And then we also do it to educate others and provide a service back to the community. As a reward for doing that, you can get some discounted rates on national training programs such as BINC, as well as some good complimentary subscriptions to the tools on the Better Investing website. So the stock selection guide and stock comparison guide. And we welcome all volunteers, no matter your skill level. Thanks. And next slide, please.
And here are the stocks we're going to be looking at for next month. We got Vertex Pharmaceuticals, and we also have Martin Marietta Materials. We have two more that are going to be coming on up. The presenters have not selected the stocks that they want to do, but it will be coming very, very shortly. So please pay attention to the notices that go on out from Carol, and we'll try to also get it up on our Facebook page. But that's really it. One last look. Do we have any other questions, Kent?
Let's see. We've got questions about how to handle actually, and the fellow who asked the questions has left. So basically handling currency conversions on the Toronto-based company. So, but anyway, that's all the questions we have. So we're good.
We've gotten to become very quiet in the audience there. We'd like to be able to hear from some of you. We see some regulars. We can have some regular conversations here. But anyway, let's keep going, and I'll show you where you can find this on Manifest. So like I said, we have some Manifest dashboards. What I do is I set them up as different dashboards by each year so you can sort of see how it is. And I have them also by the stock to study and undervalued features, and which ones were also selected by the audience to go through that. You don't have to be a member of Manifest Investing. It's a separate subscription. There's no affiliation between Manifest and Better Investing other than they both sort of agree on doing investment education and helping people. Here's the other thing you can do is that you can be able to look under the public dashboards for Manifest for it. If we go to the next slide, you'll see all the hyperlinks that we have there. So even if you don't know how to get to it, just click on those links and they will take you to that location. Again, you don't have to be a member. Please make sure to download these handouts. You can share them with other people in your club, in your family, your neighbors, whatever it is. We're just trying to be able to pass things on, as Kent said, to be able to help things better. Anything else? I think we got just one more slide. Go ahead, Cheryl.
Please don't, when you leave, just click on the leaving. Do not end the webinar for everyone, because I'm going to try to call support and see if they can fix my audio problem. And we want to thank everyone for visiting, and we appreciate your support on the webinar as well as on YouTube, and invite you to come again. Everyone have a good evening.
Cheryl, I'm still here. Do you want I won't be able to record this until you sort of shut things down, right? Sounds like you're muted.
Let me see if I can put it down here.
Well, remember, if you end it, then she may not be able to do her thing. So that's the reason I'm not leaving.
Yeah, I was trying to just stop the recording.
Oh, yeah, there is a way to do that. I don't know how to do it.
All right, where is that?